Hi, everyone. Today we're going to talk about financing and specifically financing for Canadian real estate investors. We've got the VP of BM Select, Daniel Patton, somebody who's been doing this for 20 years. He's been part of the Keyspire community for many, many years now. He's been on our stages, on panels, and I'm really excited to get a chance to chat with you even virtually. Daniel, thanks for joining me today.
Hey, Michael, always a pleasure. I want to say thank you to you and the audience for sure for having me on. Always a good time.
Awesome. Well, we wanted to call you because we're getting a lot of feedback from our members about some of the biggest problems they're having right now investing in real estate, and they're looking for solutions. And as our coaching team is giving them solutions and coaching them through it, we said, let's bring in some of our Keyspire community sponsors who are experts in specifically the financing piece. And so that's why we called you today. Some of the things I want to hit on our call today are going to be, I want to talk about how 75% of Canadian mortgages are coming up due at a higher interest rate in the medium term. I want to talk about any special programs for investors that banks are offering that we might not know about, any special programs for investors that government is offering that we don't know about. And this situation, which seems to be pretty systemic across Canada, is good income and I don't qualify. So we have families that have a six-figure plus income, but they just can't buy an $800,000 investment property because they don't qualify with all of the stress tests and regulations. And so we are going to come up with some solutions here in the next 30 minutes or so. But let's start with the problem. Like, what, in your experience, you work with thousands of clients over the years, and so many clients today. What is the number one problem that Canadian real estate investors are having financing their next income property?
Okay, so that's a big question. So let me break it down. So if the question is, what is the biggest challenge they're having financing, meaning getting the approval from the bank, what's the most challenging is a lot. Number one, you're dealing in a world where lenders are constantly changing rules. Okay. And that's a big deal to investors because as a mortgage agent, we in some cases favor some banks because their rules, might lead a deal to that lender specifically. So when that lender changes a rule and you can no longer go to that bank, that's a real challenge right now. Okay. Mortgage brokers in particular sort of favor one bank over the rest that they can really go to because this one bank has been, sort of favorable to investors. They take things like a market rent analysis. A market rent is, if you have rental properties and they're vacant for whatever reason, you're in between tenants. Some banks want you to have rental income when you're trying to qualify to buy the rental, meaning you have to show that you have the rental income for them to count it in your debt service, right? Debt service is where they're looking to see if you can afford the loan. So if you don't have tenants in there, one bank might have taken a market rent report. And that's just where an appraiser for $50 writes a report, tells you what that property would rent for, and the bank takes that and we verify rent that way. Very simple. Well, what happens when the bank changes that rule? Because that bank did recently. Starting in this new year, they said no more market rents. So that's a big challenge now. Now you have to take an application that might have worked at one bank, and now you got to take it and find another bank where it's going to work at. And banks all have different rules. They're not all created equal when it comes to debt servicing. They just have different rules. So I'm not trying to give a confusing answer, but the reality is this is what you're facing. It's challenging. It's confusing. It's frustrating. You're dealing in a world where some banks will count the limit of your line of credit versus the balance of your line of credit. And things like that will massively influence your application. So from a what's the most challenging? It's always debt service. That's the most challenging. And debt service breaks down into income versus debt and how a bank will calculate your income versus the debt you have and the debt you're trying to qualify for. When you're buying a rental, Michael, it's very simple, right? The banks are looking at three things. That's it. You have to go 3 for 3 in order to qualify for the money you want to borrow. And those three things are the following. One, you have to have good credit. Okay, well, that's an easy one. Most people know if they have good credit or not, right? So I can get that right away on a phone call. Number two, You have to have the minimum down payment, and it has to be coming from an acceptable source. And when you're buying investment properties, there's rules on that. Some banks will allow gifted funds on rentals. Some don't allow gifted funds. But down payment's generally an easy one. Oh, I've got money in my checkings and savings. I'm pulling 20% from there. So that's an easy one. So now you're 2 for 2. So what's the third? It's debt servicing. It's income versus debt. And whenever I'm saying these rule changes, all of that, we're using market rent versus now there's no rent to use. That's all affecting debt service. So that is the constant and always largest challenge of borrowing money from a bank. It's debt service.
Debt service. And that's even getting even worse today, or it's gotten even worse. And, we think about things like, in Canada, the government puts stress tests based on qualifying, right? So if if the mortgage rate is 5%, you're going to have to qualify it up to 2% higher, which pushes the payment up without pushing your income up. So it seems it's very difficult to qualify. And this is what we're hearing, Daniel. It's, my family household income is 6 figures. It's over $100,000, but I do not qualify for an income property that costs maybe $700,000 or $800,000. So we're thinking, okay, well, there's got to be a solution to help people. It's not like they don't have a job or don't make any money. They're making good money. What do we do with this situation where the person is like, what are the strategies? What are the secret strategies? Because you're doing this every single day. Yeah. And I'm going to call them secret strategies because you know them and they're second nature to you, but the world out there doesn't know them and the investors certainly don't, right? So how do we, what are 3 or 5 things, or even one thing that investor can do to qualify to buy that income property?
Yeah. So number one, again, this is a question about debt service. So how can we influence the debt service? Well, there's a few different ways you can influence debt service. So one thing you have to start with for sure is you need a professional to look at your overall portfolio. Because a lot of cases, Michael, I'll have clients that have rental properties that maybe are under rented, they're under the market rent. Maybe their amortization is down to 20 years. If I can push back amortizations to 30 years on existing rentals and bring their mortgage payment down, I'm essentially bringing down their monthly liability. If I take an $1,800 payment and bring it back down to $1,200 or $1,400, that $400 a month of savings can help increase your eligibility to qualify for more money. So when I have a client telling me that, I really need to see their application because I need to see, can I influence? Listen, again, I mentioned market rent. This is no secret. But if you're under renting a property and a bank is telling you, well, look, we'll take a market rent analysis. Do you think I should send the low rent with the lease agreement? Or do you think I could use a market rent report to get a higher rent and thus increase the ability to borrow more money? If I'm adding income to the file or taking debt away, that's how I'm going to increase, someone's qualifying ability. Now, in some cases, you're dealing with people who don't have that ability. Maybe they're self-employed and they have, lower income. Well, there's alternatives to that. A lot of people, and I understand why it's more expensive. A lot of people, I mentioned B lending. Okay, because B lending is a good alternative. They don't even really call it B lending anymore. They call it more Alt A lending because rate wise, you're not that far off from what an A lender would offer you. I had a B lender 1-year approval the other day at 5.5% on a 1 year. And if you went to an A lender right now, a bank, and asked them what their 1 year is, it's going to be pretty close to that. So rate wise, the difference between a B lender and an A lender, not a big deal, to be honest, when you're comparing 1 years. Now, somebody might say, well, compare a 3-year, it's different. Okay, but we're comparing 1 to 1 because we always want to try to leave maybe the B lender after a year. We don't want to lock in for too long. Mm-hmm. Mm-hmm. But they also charge a 1% lender fee on the loan amount. Okay. Now that's sort of the big cost. If you're borrowing $600,000, you got to pay $6,000 lender fee at closing. That's a one-time fee. You don't pay it on renewal. So it's gone after you pay it on closing. Now, the benefit of a B lender is they'll take a much more common sense approach when it comes to income. Self-employed people who are having a challenge qualifying to get a mortgage, that say, look, I go to every bank, they don't want to use me. I make all this money in my corporation or it goes into my bank account, but I pay myself a low amount of money because I don't want to pay, the high taxes. Well, that's what a B lender's for. A B lender will look at your bank statements over a year or 6 months, and they'll calculate your income based on that. A bank, when you're self-employed, is calculating your income on only your net income, whether it's a 2-year history of dividends or if you pay yourself T4s or if you're a sole prop, that they're calculating your net income, which is generally much lower. So knowing the ins and outs and navigating the client in some cases just needs to, have options. That's the thing. It's like the job of a good mortgage broker isn't to sell anything. It's to give people the option, show them, look, if you want to buy, this is the sort of numbers you're looking at. You might be looking at, a $700K purchase with a B lender, and maybe you need to find a multifamily now. Maybe you need to find a triplex where the higher rate will be offset by multiple tenants in a property. You can consider things like student rentals. So there's ways to find investment properties, but it's harder than it was a few years ago. Rates are higher, they're coming down, but they're higher. So there's net worth programs. I deal with sometimes, Michael, clients that maybe are retired now and they sold off, a company and they have money sitting in investments. Well, there's banks that will lend based on net worth. So you can get away from the debt service issue with a net worth component. There's multifamily. If you don't like residential, if you can't qualify, if you're just sitting on a bunch of HELOCs with access to capital, you can look at multifamily, because multifamily very different than residential. Residential is all about your application and what's your income and down payment and credit. But when you're buying commercial, 5 units or more, it's about the qualifying of the property. What's the income of the property? What does that support? And they sort of work backwards. If you have imagine $1 million, just simple terms, if you have $1 million multifamily and the bank's looking at the financials and it says, well, this building can afford a mortgage of about 650 grand. Well, then you have to do 350,000 down payment. And that's sort of how commercial works. So very different than residential. So there's all these different avenues you can look at to find ways, but it starts with, like anything, preparation, preparation and some homework. You got to look look at your numbers, look at your options and know, which direction you're going.
Daniel, thank you. I have 2 pages of notes already. I'm taking notes here. So let me dig deep into a couple of these things because there's a lot to unpack here. By the way, why do they call it an A and a B lender? I never quite liked that. I think that people are generally scared by the term B lender, like either the service will be subpar or they're at somehow they're more at risk because it's called a B or an A lender. Why do they call it an A and a B lender?
Yeah, they just base it on cost and pricing. I think somebody years ago came up with a catchy term of calling it a B lender because A lenders or A banks, they called them, always had the best pricing and the best rates. So as an alternative to A, they transitioned to B lenders. Now, you're exactly right. The problem is people don't like the term B, and that's why they're trying to get out of B and shift it to Alt A. They think Alt A sounds a little bit nicer.
Okay. We're going to, Isabel, we're going to come up with something. We're going to rebrand A and B lender because not one is better than the other. They both are tools. It's like saying a hammer and a screwdriver. It's like A hammer and B hammer. No, they're different tools. And you just gave us a number of scenarios where what they call a B lender or Alt A lender is a tool that you will have to use because the traditional tool doesn't work. And so the big takeaway I had is the question you said, how can we influence the debt service? Because, my situation to you is I'm making 6 figures and I can't buy a property because they don't qualify. Well, the first thing we got to say is, how can I influence the debt service, which is very simply make more money or show more income on the application or have less expenses. And so, to show more income, you said we could do a cash flow analysis, right? Show more income. Maybe the lease doesn't have the right amount of cash, but we can do a cash flow analysis. Or we are going for a multi-unit property, 2, 3, 4, or plus units. And that will increase the income and make the debt service look better. Is there anything else that we can do to increase the income, show better income on our application? Can we, if you and I were doing this, can we partner together and our income goes in, but then I guess doesn't our expenses go in? I'm not quite sure how that works, because then it's a wash. So what are, I got two, what are a couple other ways where we can show more income on that application?
Definitely adding co-signers is a big thing. It doesn't even have to be JV partners. If you've got family, I would start with family, depending on the relationship with the family, of course. But, I'll tell you, I meet a lot of investors, Michael, where the difference between qualifying might be adding their retired parents. And people think, well, my parents are retired, there's not a lot of income. Yeah, well, your parents likely don't have a lot of debt either. If they're living in a house that has no mortgage on it, and I can add in $50K of income between the two of them, that alone can be game changing. Going to the right lender is another thing. Remember, every bank's different. Some banks are going to count the max limit of your HELOC. I run into clients that maybe only checked with their bank, and their bank told them, look, sorry, the numbers don't work. And they come to me saying, Dan, I had no idea. It sounds so simple, but that happens all the time. And we'll just move it to another lender where they don't count the limit of a HELOC. And now the debt service works. Self-employed people, if you're on the cusp of qualifying, you're just under that number, I can tell you, we can do some planning in January and December, whatever you want. I can tell you what you're going to need to pay yourself for that previous year in total income. Thus, I can now plan for your next pre-approval. If you pay yourself, bump it from 80 to 100. Now I can use a 90K average. That's higher than what I was using. You can qualify for a higher loan amount now.
Okay. And this bank policy thing is really important. When I tell new investors this, they have this aha moment that, it's banks policy. There's two types of policy that plays in on if you can get financing from a conventional source or not. You've got government regulations, which is if you break that, you break the law. That's not something that we want to do. So this is example like the stress test right now, right? Everyone has to qualify within their rules on the stress test. Doesn't matter what lender you go to, they can't break those rules. But when people tell me they can't qualify, usually it's because that particular lender has a business policy. For the best example I like to give is when I was starting out, I was big into student rentals. And when I would go to networking groups and I would be buying student rentals, many every single year, I would have people tell me how are you doing this? What are you doing illegal? I went to the bank and they told me that you can't get financing on student rentals. So how the heck are you doing this? And I said, well, the problem is that bank, you can't get financing on student rentals. With that bank, you can't get financing. That doesn't mean every single lender in the entire country has that same policy. And they're like, what do you mean? I said, go to a different bank, go to a mortgage broker that has access to over 100 lenders, and then come back and tell me that nobody is lending on student rentals. And I tell you, I saw them a couple months later and they said, I did exactly like you said. And it's amazing how many people are now lending on student rentals, right? It's not the world that's changed or the markets that's changed. It's the individual investor's perception. It's their actions. It's their behavior. And so when you write, banks have different policies on things like student rentals, or in context of this conversation, on how they record income. So important that you go to somebody that has access to multiple lending sources. Because I've been to banks, Daniel, that they would only count 50% of the income from my rental, but 100% of the expenses. Are you crazy? What's going on? I ask them, and then they're like, well, that's how we do it. And then when I ask somebody that's not them, they're like, well, they're not interested in investors. So they make the policies as prohibitive as possible. And I remember going on, the big banks in Canada have a great purpose for many things, but they're generally not there to help investors buy income properties, right? And the way you can always tell is you go to their website, and as a marketer, I go to people's websites, and when I read their marketing message, if they've done it right, which the banks have big teams and they have, you can find out exactly who they are tailoring their programs to. And if you go to any big bank, it's like, new time home buyers, new to the country, get your credit card, Nowhere on any homepage does it say investor policies, right? So I wanted to spend a minute on that because I had a lot of experiences with this and investors, but I think this is an important point for people that The policy that lender chooses is one of the greatest things that influences your ability to get financing. Yeah. And the only way you can unlock those policies, well, I believe the only way you can unlock those policies is by going to somebody that has access. Like how many lenders would you have access to where you can find the right policy?
Oh yeah, over 100. When
over 100, right?
Lender, B lender, private lender, over 100, easy.
So someone comes to you that's self-employed with lower income that is buying a student rental, you're going to maybe go to a different lender than somebody that is, that has no job and that is JV partnering with someone versus somebody that's making $250,000 a year and they want to buy an apartment building. Like, they're different. The problem is people go to one lender for all of their needs versus going to a quarterback that will stack the deal properly, the lending properly. So I have to underscore how important that is for people.
And you mentioned a couple things there, because honestly, packaging the file is so important. I was going to touch on that. When you mentioned student rentals and how you were buying them early, you're right. It's still a fine line, because look, if I'm an investor and I go, my plan is to buy a student rental. Well, if I go buy a duplex that's vacant, what is it on closing? Is it a duplex or is it a student rental? In that case, if it's packaged as a duplex, you just will have more options to other lenders. So a duplex rented to students is different than a purpose-built student rental. So breaking just the terminology of that down and understanding the type of property the client's buying 100% can influence. If you walk into a bank with an accepted offer and say, this is going to be a student rental, I'm going to rent it to 7 students, you may have a problem. But if you bring a property that's a vacant duplex, or maybe even rented to people, and your plan is to maybe rent it to students down the road, well, that's a different type of deal in the bank size. You're not necessarily buying a purpose-built or an as-is student rental, right?
Yeah. So Daniel, I think this is an important point for people. And if you work with a pro realtor, it starts at the listing for me. And I'll give you my experience. I've been through this many, many times where part of my model for the first 5 years was student rentals. And if I were to start from scratch today, that's where I would start, because your cash flow is the highest. Sure, you might get a couple holes in the walls, but there's nothing that $500 extra a month in cash flow, there's very few things that it can't fix, all that extra cash flow that comes in. So I remember when I got burnt on this once and it never happened again. I had an amazing property. It was a single family home. They were moving out and I had a great opportunity to duplex it. They make it from 1 unit to 2 units. On the listing, Daniel, the realtor that was listing it said, would be a perfect student rental. Yes. Because of that, my financing, that offer I got back was, I think it was 1.5 or 2% higher, and my options were limited. So, it's so interesting that even if the listing says could be a student rental, you got to get the realtor to change the listing before it gets submitted, right? So packaging the deal. What else? What else in packaging the deal?
That's a great tip, because people think that's like, what do you mean change the listing? Well, there's nothing wrong with that. The listing is written by a realtor. And in a lot of cases, I can understand the argument of, look, it's a student rental. We want to market it as a student rental. We're going to put it all over the listing, what a great student rental it is, how close to the school it is. It's going to be great. We're going to buy. But you have to understand, to the bank perspective, and your point, Michael, that's a challenge to a bank, because if it walks like a duck and talks like a duck, then what is it to the bank? It's a duck. So if you give them the student rental, if they see it on the listing, it doesn't matter if it's vacant. That's how the bank could see it. So influencing the listing to just say, great opportunity for a first-time home buyer or investor, close to the mall, close to the schools, beautiful neighborhood, quiet. That's the stuff you want to see on a listing as a mortgage broker presenting the bank. That's how I want to see it. So you're bang on.
So let's talk about this. And, before we got in the conversation, I told you, we're just going to go whatever direction is interesting. And this is really interesting because here's one of the things that we teach at Keyspire, and maybe you can help us talk about it. I always say that when you're qualifying for financing, you're really looking at 2 different buckets. You've got to qualify as a person, or the deal has to qualify with your income. The 3 things you said: income, credit, and down payment. Those are the 3 dials, we call them. And if one is dialed down, then you have to dial the other one up. So for example, if your credit is lower or your income is low, then maybe you just have to do more down payment, right? 50% down, then you need less income. because we call these the three dials. And then on the other side, the property has to qualify. So I want you to talk to us a little bit about some of these qualification points, and I'll give you some examples. Number one, the use on the listing. So the use on the listing is one way that lenders qualify the property. Number two is the condition of the property. So I remember I used to try and buy these houses that were, that there was actually a fire and the people just took the insurance policy and wanted to sell just the house. I couldn't qualify because it was past a certain condition. And then looking at properties that were really condemned to the point where you don't even want to go in, or the city's not even letting you in. A condition of the property influenced my ability to qualify for financing. And so if those are two, and you can even tell us about those two a little bit more, but I'd love to know, are there any more conditions around the condition of the property that influence an investor's ability to qualify?
Yeah. So use is a big one. Again, it's a great point, because if the listing, imagine if I'm trying to buy a property and the current use of the property is it's a medical office in the basement, that can start to cross over into commercial lending, and residential lenders can sometimes say, we don't like the commercial aspect of that property. We're going to pass because of the use. And you, as the buyer, are saying, well, look, I'm not going to have it as a doctor's office. I'm going to get them out and I'm going to convert it to a duplex. But what is it on closing to the bank? What's the use of it on closing? If it's used as a medical office, then that's how they're going to treat it. If it's, if the use is anything commercial, that stuff can influence it. So use is a big thing. What is the current use? If it's being used as a student rental, that can influence it, like we talked about earlier. Yeah. So let me tell you a funny story on this, Daniel. That's interesting. So this got me into trouble a little bit in the early parts of my career, where I would buy a property and then put in a number of bedrooms before I understood the laws and regulations around, say, having a rooming house. Right. And so interconnected smoke alarm. So if every municipality is different, just so for everyone watching, different rules on density, how many people can live under one roof. Some are okay with 5, some are okay with 2. Some, if you have more than 3, you got to put certain things, fire doors and stuff. So I learned that and ended up just going in that direction in terms of increasing the value. But I remember one time, before I knew these rules, I went to submit I submitted my application for financing, and then I had like all the plans drawn up of what I was going to do with the property. And instead of being like bedroom 1, bedroom 2, bedroom 3, bedroom 7, it was like bedroom 1, bedroom 2, bedroom 3. Here's an office, this room, office 2, office 3, office 4. And I'm like, oh, they're not bedrooms. It's fine. And then they're like, this is an office building. We're going to charge you. We're going to send you our commercial. I'm like, wait, that wasn't my intention. My intention was just to not make it, to make it look like there wasn't as many bedrooms. So it's just interesting in terms of all these details count. Like if you have 7 offices that are really bedrooms, you got to put bedrooms, you got to do it properly. So, use of property, that's my story. Another story, use of property. Now, just to be on the positive side of things as well, it can work for the reverse. In some cases, properties are zoned residential and commercial, but the full use is residential. And we can, in those cases, get that deal approved residentially. So again, it can work both ways. It can favor you if the use is fully residential, but it's zoned residential commercial. In some areas of the GTA, I'm sure all across the country, we have, properties that are sort of grandfathered in. They're used as residential, but the zoning is residential commercial. So
interesting.
You want to be careful of those properties, when you're putting the offers in, but you definitely have a chance of residential financing on those residential commercials.
Okay, good. So we've got use of property influences your ability to get financing, the condition of the property.
Oh, that's a big one.
Is there anything else in terms of what the lender looks at regarding not the person, but the property? Like, is there anything around, if you come in with a good business plan and a 5-year outlook, do they care? Does that matter? If you come in with, a good renovation plan, you're like, look, we've got all the renovations. Does any of that stuff matter to the lender?
Not when you're qualifying for the initial property, not the plans of what you're going to do with the property to a bank. They're like, how do we know you're going to do it? That's literally how a bank looks at it. So until it's done and completed, they don't want to hear about it in a sense. Now, again, unless you're applying for certain programs, there's a program, Purchase Plus Improvements, that, you know, you go out and try to qualify for. So in those cases, you know, you want to qualify up front. But one area is just the appraisal. The appraisal alone is a big part of the approval. Because remember, if you're an investor buying a million, let's just say $1 million home, we'll assume it's a fourplex, the rents are good, and you have to do $200,000 down because you have to do 20% down. Well, if you don't have backup, meaning if you don't have the ability to come up with additional capital, and that appraisal, let's say for whatever reason, maybe there's no comparables, is coming in around 920 grand, then you as the investor have to come up with that shortfall on closing. So you have to prepare for the appraisal. The appraisal is a big part of, you know, the process of the property. That's got to pass. And within the appraisal, they'll look at things like, what's the condition of the home? Is it a hoarder house? We don't love hoarder houses as a bank. It's not livable in our eyes. Nobody can live there. They don't want to take over houses and have to power of sale people out and sell them. So they don't love a hoarder house. What's the completion of the house? Oh, there's a giant hole in the kitchen ceiling because there was a big leak and I'm going to get in and fix that. Well, to the bank, listen, if there's a giant hole in the kitchen ceiling, you may not be able to live there. That's not necessarily livable. We as the bank want that fixed prior to closing. So the property itself, if you're buying a new construction, the property itself has to be 98% completed before a bank will finance it, you know? So refinancing, if you're under renovations and you're halfway through, you know, you're buying a property that's, excuse me, halfway under construction. These can be challenges because a bank wants 97 to 98% complete.
Okay. And I see that as I just made my note. The appraisal is like the way I think of it. That's like the way to measure all the things we talked about. Yeah. Right. So it's like they're interested in the use of property, the condition of the property. If you're stating any improvements on your Purchase Plus improvement, are those improvements going to happen based on the pictures in the appraisal? And then they order the appraisal to validate all of this stuff. So that's kind of like your document, their document to validate what you're telling them. Yeah. And then same thing on the personal side, they're going to use certain mechanisms to validate credit. They'll run a credit report. To validate down payment, they're going to probably want to see your bank account or bank statements. Maybe some lenders will want some sort of, you know, what we call seasoning, like, oh, it's got to be there for 30 days or 90 days, where some lenders won't. So, you know, I would go to you, I'd say, Daniel, I got some money. I don't want to tell you where I got it, but I got some money. And it's been in my bank account for 30 days. Can you get me a mortgage, right? And maybe that came from a joint venture partner or a gift from a family. But you're going to now find lenders that have a seasoning policy that's, you know, inside of 30 days.
Yeah, absolutely. If we're in the business, and you mentioned this earlier, it's very important that the banks aren't trying to lend people money to buy rentals. They're just not. And it's an important message because we as investors have to understand that we're playing within their rules. We're playing within and we have to fit inside their rules and guidelines. Otherwise, we don't get the money. They have the power. Now, the flip side of that is what we do. It's okay, then give me the rules, Mr. or Mrs. Bank. And I'll figure out a way to play within your rules. And if your rule is give us a 30-day history of the money in an account, then I will give you a 30-day history of the money in an account. So we, as an advantage, it can work for you and against you. You know, sometimes it works against you because you're limited on some rules and they just won't change it. But in other ways, you can influence the deal because you know their rules and you can give them what they want. And that's all it is. Give them what they want, right?
That's an interesting way for us to look at that as retail investors, me and everyone watching that wants to go buy income properties, is if you don't work with a mortgage broker or a mortgage agent, it's like you're playing a game that you don't even know the rules to.
Yeah.
Right? Imagine going to sports and you're playing a game. You're like, what are the rules? I don't know them, but I'm going to try and win. You have very little chance of winning if you don't know the rules. So you need the referee. You're our referee, and you're like, okay, you're playing that game, student rental, self-employed, 80,000 income. Boom. Here's the rules for that game. You're playing that game. Here's the rules for that game. You're just getting started out. You are a student. You have no money, but you have 3 partners that are that are going in with you, and your parents are giving you a gift. There's the rules for that game. And so I like it the way you said it that way, because it's like, if we are trying to win at a game and we don't even know the rules, we've got a very little chance of ever winning that game.
Yeah. You got to know your opponent, right? And in a lot of ways, the bank is our friend, but they're using us and we're using them. They want money from us and we want money from them. So if we, have this relationship with them and we play by their rules, then we'll get what we want in the end.
Yeah.
And that's investing. And not every deal is cookie cutter. You have to find ways to get the bank to work to your advantage.
Yeah, great. So you mentioned, let's get into some programs. You mentioned the Purchase Plus improvements, which was always one of my favorite programs. Let's talk about, if you can outline, and then we'll talk about them in detail. What are some special programs that banks offer? Or I'm not going to use the word banks. We're going to use the word lenders. Could be an A lender, a B lender, alternate lender. Mm-hmm. What are some programs that lenders have that, in your experience, are the best programs out there right now, specifically for real estate investors? So I'll put Purchase Plus improvements as one, and we'll come back to them. But is there anything else that comes to mind?
Yeah. So there is one lender, this sort of qualifying has disappeared over the last 15 years, where they called it a DCR. Okay. And the DCR qualifying is when a bank doesn't really look at your income, they look at the overall performance of your real estate portfolio.
That's nice.
As a way to qualify you. So if you're retired, you have low mortgages, your properties are all cash flowing, and you can't figure out why you can't qualify, you need a DCR program. There is one lender, and this lender doesn't work in the mortgage broker channel, believe it or not. But, my company, BM Select, has nurtured a relationship with this lender to the point where we can submit deals directly to them. We can do that for the client for no additional fees, nothing like that. But they have the traditional DCR program. So that's a huge advantage for people who are in that scenario. If you're an investor and you got cash flowing properties and you can't qualify under the traditional debt service because you're retired or self-employed, well, you got to try that DCR program, because that's built for investors for sure.
Okay. What does that stand for? Debt coverage ratio?
Coverage ratio. Yeah,
really? Okay, got it. Debt coverage ratio program.
Yeah, and they're just plugging your numbers into an Excel spreadsheet. That's what we are. You're taking the rental income of the property. Now, again, it's provable rental income. They want to see the leases and bank statements.
For sure. So you're saying they're going to take all my rental properties, because this is a problem that investors watching are having right today. Yeah. Michael, I got 5 investment properties. They're all doing well, but it seems like the more investment properties I get and the better I do as a real estate investor, the harder it is to get financing. And they come to me and they're like, somebody with 10 properties, it's just as hard to get financing as that person buying that first property, or even harder. And so that seems a little crazy to me. And you're saying there's a DCR program that is very rare, but that's actually going to take into account that, look, I got 10 properties, I've got good equity, I'm making good cash flow, and I'm buying number 11. Is that the scenario? Love it. Yeah, they'll allow you up to 40 doors, believe it or not. So. Love it. That's amazing. Okay, so we got DCR, we got the PPI. What else? So what else we got? Some investors, okay, this is a recent one. This is a good one. Some investors don't own rental properties. Okay, maybe they can't qualify and they're looking for ways to convert their existing home into a rental property. Maybe I want to convert my basement to a second unit, or maybe I want to add a garden suite onto my owner-occupied home. Well, traditionally, previously, up until the end of the year, you could only refinance to 80% of the value of your home. So again, I always use $1 million because it's easy for me to just use numbers based on that. But if you have $1 million home and I want to pull money out, I can only pull out 80% of that. So 800,000. So if I have a mortgage of 750 or 760 and I want to pull out 100 grand to go do renos, I can't do it, right? Because there's not enough equity. I can only pull out 800,000. So one of the programs the government recently came out with was this refinance ability to 90% of the owner-occupied home. And the condition of that, or the sort of attachment, is you have to be converting the home to a multi-family home. So are you converting it to a garden suite? Are you converting, or adding a garden suite, I should say, or converting it to a duplex or a triplex? As long as the renovation went towards the conversion of the property, you can refinance up to 90% of the new value of the home.
Okay. Now that's only on owner occupied. There's some investors that are creative and say, well, maybe I'll move there and do it. Like there may be some leeway if you're living there. Again, it's a tough program, but it's designed for an owner occupied home for people who are converting to a multifamily. And that's 90%. I mean, that's a big number. I haven't seen that since, I can't even remember, 2005. I think when I got into mortgages, you could refi to 95%, if you can imagine. They got rid of that pretty early on. And since then, it's only been 80. So
I love this program. I mean, as an income property investor and my starting out putting income suites in properties so I could have more people have a home, this is needed today more than ever.
Yeah.
Not only with sandwich generation families where families have older kids, but they have to live with them because no one can buy a freaking house anymore. That's why we're talking. Or older parents that are right sizing or want to stay close to their kids and they're going to be in an income suite. This program seems to be more valuable than ever. So is there a name to this program that you described?
Man, I don't remember the name of it off the top of my head. It's just, if you Google the CMHC refinance to 90%, it would come up there. There'd be a lot of literature. We talk about it on our newsletters and webinars and things like that too.
Maybe we'll do something in the future about that. And basically, what the outcome is, you need a low down payment or a high loan to value refi for conversions, owner occupied conversion.
Well, and a lot of investors think, look, I have to own an owner occupied and then go buy a rental, but you don't. What if you own the owner occupied, convert it to a multifamily, rent that property out, and move to a new owner occupied? Well, now you end up in the same position with one rental and one owner occupied. That's
great. Now, here's a strategy, and I know we're almost at time, but this is a fascinating conversation, and we're all learning a ton, so thank you. This situation where an investor wants to go out and buy a 4-unit building. Okay, so 2, 3, or 4 units. And if I were starting out today, this is exactly what I would do. I'd buy like a 2, 3, or 4 unit building if I needed somewhere to live. And so I want to live in 1 unit and I want to rent out unit 2, 3, and 4. How does financing work for that? And we'll ignore 5+ in a moment, because I know earlier you said that's kind of more of a commercial policy. And generally from 1 to 4 units, we can have access to some more residential policies. I don't know if that's good or not. Tell us, is that better or worse? Is it better to go 4 units to get residential access, or is it better to go 5 units so you have access to different types of financing? And what are those financing? Can I qualify in my income versus qualifying the income of the 5 units versus just my job income, which I don't qualify. That's why I'm here. So I want to get some idea on how we can help people buy a multi-unit that they're going to live in 1 unit and they're going to be renting out the others for income.
Okay, so really good question. And in a weird way, we'll talk about residential, and then if you want to touch on commercial.
Let's start there. Yeah.
Okay, so residential, it's actually more favorable for you to do that, because traditionally, when you're trying to buy with less than, let's say, 20% down, let's say you're somebody who has 5 or 10% down, and that's what you're trying to get in the market. And the only way to get in is to maybe buy a property that you live in and rent out the other units. Okay. Not everybody has 20% down. So they're trying to figure out ways in. Now, why do we have to put 20% down? The reason is because, for those people that don't know, when you have a mortgage that's insured through CMHC or Genworth or Canada Guarantee, they call it Sagan now, not Genworth, but through any of those insurers, they will not insure a rental property. It's that simple. So if you tell the bank, my intention's for it to be a rental property, they don't insure that. And that's why you have to do 20% down.
Because you could go more, you could do less than 20% down if it's not a rental property, right?
That's right.
We have programs in Canada where if you're buying your home, you could go as low as, say, 5% down. Got it.
That's right.
Those programs don't apply to us as investors.
That's right. The insurers will allow you to, when you're buying with less than 20, there's only 3 ways you can intend to buy a home in Canada. 1, primary residence or owner occupied, right? I'm going to buy it, I'm going to live in it. 2, I own a property, but I'm going to buy a secondary home, a cottage, or a property for a family member to live in. That's a secondary home. And then 3 is an investment property, a rental or an investment, flip, something like that. Now, the insurer, CMHC, will only insure 2. They'll only do owner occupied and secondary home. That's it. So if any of the insurers know it's a rental, that's why you have to do the 20% down. Now, where it's an advantage to the residential people is as long as you are occupying one of the units, you can do 5% down on a duplex.
Wow.
Do 10% down on a triplex or fourplex. So
wow, that's huge.
Yeah, you can put way less down if you're going to live in one of the units. And that, imagine, Michael, if I'm trying to qualify somebody to buy their first home and they're just buying a single family home versus buying a home that has 3 rental units attached to it.
Oh, wow.
Use rental
Game changer.
income, the pre-approvals
Game changer.
higher. Yeah. So hugely advantageous on the residential side because you can put less down, and obviously maximize your pre-approval with the higher rent.
That's a game changer, Daniel. I love this. And this is what we should be talking about for the remainder of our time here, because this is so powerful for people. This is maybe half of our audience at Keyspire in terms of I want to buy a home and I'm willing to move into it. This is the number one strategy, to buy the home and move into it. I mean, if you're not moving into it, that's fine. You're going to buy it, rent out all 4 units as an investment property. We just know that we need 20% down. Right. So we need 20% down. Now, the whole other conversation of there's no such thing as a no money down deal, Daniel. You have to put money down, but it doesn't have to be your money. Those are not your money down deal. So that 20% can come from other sources, but that's a conversation for another day. I want to help this person that's looking to buy a home. They're going to live in one unit. They're going to unlock the 5% down versus 20% down. And then how does it work with the, our most important topic today, which was the debt service, income versus debt. Now, have we increased the income significantly without really increasing the debt? I mean, we have 95% debt on the property, but our car payment doesn't increase 3 times with 3 times the income. Our other bills that are all included on the expense side don't increase. So to me, this is the number one way to influence the debt service and make it look better by increasing the income with a very smaller increase in debt. So how does that work? They qualify, all that income is included?
Yeah, not 100% of it. I mean, like you said, it's something. Something's better than nothing, right?
Yeah.
So using something, and it can be enough. An extra $1,200 to $1,500 of rental income alone could add $50,000 to $75,000 to your purchase price. So you start getting into a fourplex where it's like $6,000 of rental income.
Yeah,
that's increasing your purchase price by a few $100,000. And you brought up one thing that I can't believe I forgot to say. Paying off debt is another way to massively influence. Paying off car payments and credit card debt, getting rid of that can increase your ability to borrow more money too. I left that one off. That's a big one. So
let's go there next. We talked a lot about influencing the income side of the equation. But there's also the expense side of the equation, and both of them have value. So on the expense side, what are some strategies that the investor can do to positively influence that expense side? Or that's a fancy way of saying lower the expense side. So one way you gave us is by increasing the amortization. That's the number of years that your payment is stretched over. So if someone hasn't encountered that, you might get a 25-year amortization. That means what you owe, principal plus interest, is divided by 25. The payment is the same, but it's non-linear in terms of the amount of principal and interest, which isn't important for this conversation. But the payment is going to be a certain amount. Now, if you take that same amount you owe and you stretch it over 40 years, well, your payment's going to be lower because something divided by 40 is lower than something divided by 25. And on a side note, Daniel, I always used to tell people, give me the longest amortization possible. Like when I was getting into this, I wasn't tainted by I was 20 years old, so I knew nothing about this stuff. And I was just like, what makes the most sense? Pay it off over 50 years. That way my cash flow is as high as possible. So I would get the longest amortization I could. My income and expense ratios would be the best they could possibly be. And then this is my favorite part. Every 5 years, I would refinance. We call it flip to yourself at Keyspire. And I would increase the amortization. And people would say, are you crazy? Don't you want to pay this thing off? Like, you're never going to pay this thing off. I said, that's fantastic because I'd rather have $10,000 a month in cash flow than a paid off property in 25 years. And people are like, whoa, okay. Then they see the property as a vehicle to support your lifestyle freedom day as opposed to a job that you're trying to get to an end result and retire to. So that's just a little side rant that is along the lines of increasing amortization.
It's funny you say that because I tell people all the time, I go, listen, you have to look at amortization in the right way. It's not a jail sentence. You're not sentenced to 25 years and you have to stick to 25 years. Amortization is a tool and you use it for your benefit. And and just like you said, it's to be used for things like that for your advantage. With listen, you can make the argument, with an owner occupied home, I want to pay off the non-deductible debt as fast as possible. I get that. But on rentals, on investment, on deductible debt, you want to leverage deductible debt in finance and make the money off of the deductible debt.
Yeah. Excellent. And the reason you're mentioning deductible debt is because if you're still paying a mortgage on the property, you're still getting some debt payments, but that's fine because you've had 25 years of better cash flow that more than offsets it. The math more than offsets it. So there's increased amortization. The second one that you mentioned, and I did this a lot as a private lender, is pay off the debt. So pay off some debt. Well, people are going to say, Daniel, Michael, I can't pay off the debt. I don't have the money. I just saved it all for this freaking 20% down payment, or 5% if you're going to buy the multifamily CMHC. But what I used to do, Daniel, and tell me how this plays into investor strategy, is I used to be a private lender and I would lend people money and it would be 12%. So it wouldn't be the 3 or 4 or 5% they were getting at the bank. But what that allowed them to do is allowed them to pay off the debt that showed up on their credit bureau with my money. They would pay me that premium, but because of that, they were able to either refinance or purchase a property because they're influencing the expense side. And then once they refinance, they just pay me back the money at the lower interest rate because I've been able to add improvements and add value, which creates value to the world. Tell us about, is that a strategy that investors can use? Is, hey, if I just paid off this $10,000 credit card bill, my mortgage broker tells me I'd be able to qualify and I can get that from other sources.
Yeah, big time. So the bank calculates monthly liabilities based on payments. So if you have an installment loan, like a car loan or a boat loan or a musical instrument loan, anything like motorcycle loan, you have a fixed payment on that loan. Okay, that's what the bank counts. $500, $1,000 a month, whatever the payment is, that's what the bank counts. Now, credit cards are different. Credit cards, the bank will count a 3% payment on the balance. So if you have a $10,000 balance, they're counting a $300 a month payment in your liabilities. So to answer your question, Michael, if you have, an average Canadian might have 30, 40, maybe $50,000 in debt, that's not uncommon that we see these days, especially with the way things have been going over the last couple of years. You take on $50,000 in debt. Well, that's a $1,500 a month payment the bank is counting against you. Well, if I was to put that and wrap that, and that's just for the credit card debt. What if you have a car payment that has a balance of $10,000, but the payments, $600 a month? Well, the bank counts they don't care how much is left. They count the $600 a month.
10,000, Daniel. These days, people are buying $70,000 cars all on payment.
Exactly.
$100,000 cars.
Exactly. So, okay, imagine if you're taking a $50,000 car that has an $800 a month payment or $1,000 a month payment, and you have $50,000 in debt. To the bank, that's a $1,000 payment on the car. Let's just say that's the payment, and you're $1,500 on the credit card debt. That's $2,500 a month now in liabilities. If I wrap that into a mortgage, okay, just for optic purposes, if I put that into a private mortgage at an interest-only payment, say $60,000 at what was the numbers you said?
12%.
Okay, so 11.99, which in second position would be a pretty good, deal for both parties. Yeah, it's pretty standard. You're probably somewhere around somebody's going to pull this up, but probably $400 or $500 a month.
Yeah,
that.
It's good.
So you're now taking a $2,500 liability that's now dropped down to a $500 liability. I just knocked off $2,000 off of your monthly liability. So yes, moving debt around, if you have a HELOC, they count a different payment on your home equity line of credit. So just shifting debt from paying out your car, if you have a $20,000 or a $30,000 payment on your car, $1,000 a month, and I go move it to your HELOC and it's a $30,000 balance on your HELOC, that payment's like $300 a month. So again, that I just saved $500 to $600 a month on my liabilities. So shifting the debt around absolutely can help increase it.
Good. I want to make sure people know that. That's what I did as my investment business for many years. All my debt-based business was around this exact ideal customer, somebody that was looking to reduce the payment. They needed to rent my money for 6 months or 12 months. They're just renting my money to make it look better and to make it and to have it all wrapped up by a mortgage broker. And then the outcome, everybody wins on that outcome. So okay, that's number 2. Pay off the debt. Is there anything else for expenses? I know we're at time, but how else can I reduce my expenses? I've had lower debt, increase the amortization. Any other ways? I mean, spend less, right? Go out there and I mean, you can always trade in that car for a lower car payment. Like, how bad do you want to secure your future? You can always change your expenses. Not always, but sometimes you can change your expenses by not driving that car that's so expensive, or, not doing the things that are creating those payments.
Yeah, 100%. Just reshifting the debt. And that's the biggest thing. Again, adding income, we sort of talked about. So how to take away debt. I mean, you're limited on options on how to take away debt. You're either adding income to the file, so the debt is heavy, weight is heavy, or you have to lower the debt. So how do you lower it? You pay it off. You borrow money if you have to. You bring those debts down. The good thing is you're not doing it blindly. You have someone like me telling you, these are the debts we have to pay. Yeah. Right? This is the one. So if we do this, there's a plan in place. If we stick to the plan, and then it'll go smooth and we'll get the money we want. But again, we have to come up with the plan.
Yeah, that's, it's a good point, is like all these things we're talking about are great if you know the rules. Yeah. If you don't know the rules of the game, then, these strategies, you're kind of just guessing at it. So working with a competent mortgage broker, working with a competent investor-focused realtor is really important. What Keyspire, you've got your coach, you've got your community. And the way we see it, Daniel, and this being with us for years, all of these pieces are important. And they're all needed in order to make sure that you have the best possible chance of being successful. We want to increase return and lower risk. Nothing is zero risk, but if we can if we can have the right investor-focused realtor, mortgage broker, insurance agent, coach, community, training, events, now you've got that holistic sort of package to support you. And thank you for being part of that package for people. I mean, you are one of our Keyspire Community sponsors, one of our mortgage providers, and we hear great things, and we're just really happy to have you part of this.
Oh, thank you so much. Again, it's great. We've worked with investors for years. It's sort of a great niche that we've carved out. We've been doing it a long time, and we love it. I mean, we like complicated files. That's sort of what we're built on. And
you guys are suckers for punishment. I never understood why some brokers are like, I want to work with investors versus the first-time home buyers are like the easiest, right?
You know why? Because first-time homebuyers for the same reason, but because investors, you truly, and you'll get this, you build long-term relationships with people, and business on any level is about relationships. And if you're honest and you take care of people and you help them achieve their goals and help them along the way, as a mortgage agent, their house becomes such a tool for them to build wealth and buying properties. So we get to go along with that journey with the investor. We work with investors where you might be working with them for 5 years straight, just working on a purchase here, and now you're refinancing here. So just like investors investing in property, the investment for us to investors has been amazing. You build the best relationships.
Nice. Well said, Daniel. Well, thank you for being here. Thank you for joining me. We'll check in a couple times during the year. I know you're going to write a couple blogs or articles for us as well for our members so that they can see what you're up to and what the latest strategies are. So thanks for being here. Appreciate it.
Thank you.
All right. We'll talk to you later.
See ya.